If that were to happen, but a panic first, okay, T-bond collapse. Don't be shocked if silver goes vertical for several days. Like maybe it doesn't pause till it's 120, 130 bucks, and maybe has a couple limit up days, 10% per day on the COME. It is not a normal bull market. We've been telling our subscribers that for well over a year, but it's gone up in an arm wrestling manner, both gold and silver. You know, they shoot up a couple $100 in gold or 10 bucks in silver, and then you go sideways for 5 months and bore the heck out of everybody, make people think it's over. Then you do it again. And then there's another congestion zone. And it's been laborious. It's no longer laborious. It's going to go vertical. There probably will be, I think, a correction in this process. But our technical work coming at these markets from different angles, by the way, not just looking at the price and the momentum of price, but at the spread relationship between silver and gold. You know, the baby metal mama currency and the big old mama currency. And silver's vastly undervalued, historically speaking, to its prior relationships to gold. And I think that's going to change dramatically and suddenly. And that's the key word, sudden. I think we're in one of these, what we call a move to new reality. It's occurred in other markets. We found an instance of it. It occurred in copper back in 2005 to 6, where copper, in a matter of a couple quarters, quadrupled in price on its own, without help from any other market, and went from an old multi-decade horizontal reality and just said, boom, I'm out of here. And quadrupled, you know, a new reality.
Yep.
Lead did that in 2007, which was ridiculous. But, you know, it did. How come silver has still been caught in that half century, $50 to $4, $50 to $4 range, and only recently has broken out?
Thank you. That's the question. Yes.
I think it's going to a new reality, and our measurement, based on a variety of factors, not just looking at silver itself, is that this move is going to take us to a new reality, and much of it is going to occur in a few quarters. And we begin that clock. In other words, where did the couple quarters begin? We begin it at the November close. And the reason is, it was at that point in time that when we looked at the relationship of silver price to gold and plotted it as a spread, you know, ounce of silver into an ounce of gold, it's a certain percent. Okay, you just simply plot that chart, and it was a ceiling that went back years, quite a few handful of years, where you go up and bump a certain level and bump a certain. Silver just couldn't get above that value of gold. It broke through there in November. We've gone back and found other few instances of this type of behavior, where silver said, I'm out of here, okay, versus mama gold. And it went vertical for a couple of quarters after that. This time, there's other factors in play as well, fundamental, macro technicals, and so forth. But we've been arguing since November that what we're about to see in the next a handful of months or so, you know, 5, 6, 7 months or so after that November breakout, therefore starting in December, a vertical move in silver that's likely to take your breath away. Not just to go up to 90 or 100, but go into a couple hundred, possibly 300 to 500. There's some rationale for that, by the way. Various angles of analysis give us that conclusion. And we think a lot of that's going to occur by the second quarter of this year. Obviously, that's not going to occur in isolation. Gold's also going. And I think gold at 5,000, for example, which is headed for now probably, is way low. To give you an example, stupid one, but I've put it out before. People think that's his target. It's not. If you go back and look at the bull market from 1976 to 1980, it was an eightfold gain in gold. 8 times, okay? But look at 2001 to 2011. Eightfold move from the prior bear low to the bull market high. Our bear market low was 1,050 in December 2015. Eightfold is what? Okay, 8,000 plus. That's just to do what gold has already done twice in the last 50 years under far less dramatic fundamental conditions. Eightfold. Right now we're only a little past fourfold. What if gold goes to 8,000 again and silver goes up, breaks out versus gold, which it's done? It goes up to, 3%, 6%. Those are numbers it was at in 2011 when gold had that bull market run up into 2011, which was the second hit up at 50. Silver spread then was 3.1% of the price of gold. Right now we're just 2%. In 1980, when it had that surge to $50 for the first time, it was 6.5% of the price of an ounce of gold. Wow. Consider those numbers. All the above, but the bigger picture, I think, really is the one people don't talk about, and that is we're headed for a monetary crisis. I think fiat currencies are in jeopardy. We know, if you haven't been paying attention, and I'm sure you have, and your audience as well, the T-bond market is on ambulance stretcher right now, okay? Not just our bonds, the Japanese bonds effectively crashed today, exploded in yield. UK bonds don't look very good. The Western world bonds don't look good. We're no longer talking about a mortgage crisis like 2007 to 8, where this mom and pop lost their home, et cetera, et cetera. We're talking about government debt, markets that dwarf the stock markets. And if you'll look at the T-bond futures, which is what we analyzed, 30-year bond futures in the U.S., they crashed between 2020 to 2022 in price. Yields exploded, okay? That price low back in October of 2022 was at 117 on T-bond futures, okay? Just remember that. In the subsequent 3 years, there have been rally attempt after rally attempt. In fact, 3 of them. The 3 is usually all you get to get up out of the hole. Fed can cut rates all they want on the short end, but it doesn't affect the long end rates. And they failed each time. Right now, we're down in the 114, even traded into the 113s today. Our technical analysis tells us that that 3-year process of trying to base or trying to top yields is failing. And if you roll over about another 3 points or so in the bonds below today's low, which when you look at a price chart, it doesn't break below the lows we've seen over the last year or two. But you do that and you could be headed into a bond panic. Well, you can't have a U.S. debt market panic. That's like a nuclear event. The Fed knows that. They're the printers, and they print gold higher because they destroy their own money in the process of print. In November, President of the New York Fed, Williams, said in a speech or press conference, the Fed is now going to start buying bonds. And his excuse was, just to provide more liquidity in that market.
If you've been watching the silver market over the past several months, and you still think we're in some kind of normal bull cycle, let me stop you right there. Nothing about what is happening is normal. Nothing about the tape, the spreads, the breakout behavior, or the macro backdrop resembles any past orderly move. We are transitioning, fast, into what I've been calling a move into a new reality. And if you've never lived through one, buckle up. Because these moves don't whisper. They don't politely knock on your door. They grab you by the collar, drag you outside, and make you watch a market go vertical while everyone who thought they'd wait for a pullback stands frozen in disbelief. Let's start with the idea of silver having several days, possibly consecutive days, of limit up trading. A lot of people don't even know what that looks like. The COMEX has daily price limits. Silver can move 10%, and then trading halts. Now imagine that happening back to back. Imagine silver blasting from $90 to $120 in one session, then to $135 the next, with barely a pause, barely an offer to buy physical, barely any supply at any premium that resembles sanity. That's what an air pocket breakout looks like, and that's exactly the type of behavior we're warning subscribers about. Not because it sounds dramatic, but because the technical structures have been foreshadowing it for over a year, and now they've fully confirmed it. The arm wrestling we saw throughout the past year, those long grinding sideways consolidations after every explosive move, was exactly the kind of deceptive coiling that precedes a straight line surge. Think about the pattern. Silver jumps $10, then chops sideways for months, boring everyone to sleep, convincing people the move must be over. Then it does it again, and again. This is not random. These are congestion zones that mark institutional repositioning, not retail exhaustion. When a market shows you that pattern more than once, you should stop thinking in terms of $5 or $10 moves and start thinking in terms of regime changes. Arm wrestling markets don't end quietly, they end violently. Now, the spread work is one of the most important components of this entire situation, and shockingly, it's what almost nobody on financial television ever talks about. Everyone loves price, but price is just the tip of the iceberg. What matters is the relationship between silver and gold, the baby monetary metal and the mother monetary metal. And historically, when silver is deeply undervalued relative to gold and finally breaks out of a multi-year ceiling in that spread relationship, what comes next is not incremental. It is explosive. It is sudden. It is vertical. And it usually happens within just a few quarters. That ceiling was finally broken in November. That's when we officially started the clock. Because we've seen this movie before. In 1979, when silver broke out against gold on the spread chart, It quadrupled within 5 months. Not years, months. Same thing in 2010 to 2011. Silver had been sleepwalking behind gold for years, then finally broke out relative to gold, and boom, it doubled and a half in 7 months. These weren't coincidences. They were structural repricings triggered by spread breakouts. And the breakout we just saw in November isn't small. It's not modest, it's monumental. Which brings us to the core question. Why has silver, unlike copper, unlike gold, unlike lead, remained trapped in a 50-year range? Why has it lived its entire modern lifetime inside the same $4 to $50 box, bouncing around in the same boundaries like a prisoner refusing to escape? Everything else broke out. Copper quadrupled in 2005. Lead quadrupled in 2007. Gold shattered its 1980 highs and never looked back. So how is silver still pretending it belongs in that 1970s reality? The answer is simple. It doesn't, and it won't. The mathematical implications of a range repricing are staggering. On a logarithmic basis, the move from $4 to $50 was a 10-fold increase. Add that dimension to the breakout level, and you don't get $100 silver. You don't get $150 silver. You get the possibility, yes, possibility, of $300, $400, even $500 silver before the dust settles. That's not a fantasy. That's just math. That's just the dimension of prior moves applied to a breakout that should have happened decades ago. But the technicals aren't the only thing pushing this. The fundamentals are screaming in the same direction. Industrial demand is off the charts. Supply deficits have continued for years and are accelerating. The COMEX is being asked to deliver real metal, not settle cash differences on paper contracts. Spreads are widening. Premiums are rising. Central banks are hoarding gold at record levels. And what do you think happens when monetary panic pushes investors down the ladder to silver? All it takes is a few percent of gold investors rotating into silver, and the whole supply chain snaps like a twig. Now here's the part that few people understand, but everyone should. The internal health of the US bond market is in critical condition, and if the long end of the Treasury curve rolls over, it will trigger one of the most powerful monetary metal surges we've seen in half a century. Bond yields are no longer responding to the Fed. The long bond doesn't care what Powell says or does. It's trading on insolvency risk, on supply-demand imbalance, on the geopolitical abandonment of US debt by foreign governments. Japan's JGB market blew up, the UK gilt market imploded in 2022, and now US treasuries are showing the same stress fractures. These aren't cracks in the drywall. These are structural fissures in the foundation. The futures market shows it clearly. T-bond futures crashed from 2020 to 2022. Every attempt to bottom has failed. 3 failed rallies, the classic maximum number before a deeper collapse. Now we're trading below 114, even touching the 113ths. Our momentum models show that if bonds lose another few handles, you have the makings of a genuine bond panic. Not a correction, a panic. And if that happens, the Fed will be forced to intervene. Not with rate cuts, but with outright bond buying. They will call it liquidity support. They will claim it's temporary. But make no mistake, it will be QE in everything but name, and it will ignite gold and silver like gasoline on a fire. And here's the part the public will never be told. The Fed doesn't buy bonds to help you. It buys bonds to save the system. The entire monetary regime depends on stable treasury prices. A treasury panic would be a monetary heart attack, and the only defibrillator they have is the printing press. They print dollars, and in doing so, they destroy purchasing power. They don't just push gold higher, they launch it. They launch silver even faster. The metals don't rise because they're strong. They rise because the currency is dying. Now think back to what John Williams at the New York Fed said just weeks ago. We are going to begin buying bonds to provide liquidity. That sentence should make every serious investor sit up straight, because that is the exact same language the Bank of England used right before the gilt market imploded. Central banks always say they are providing liquidity. They never say they are preventing collapse. But markets know. They know the difference.